Welcome back to the Neuro Finance Masterclass. Today, on day 125, we crack the absolute speed and horsepower gauge of market trends.
You got it, Ibrahim. Today, we're diving straight into capital trend power engineering. We are looking at one of the absolute best, most powerful analytical tools in an architect's arsenal, the ADX indicator. Now, if you've been with us on this journey, you already know we just don't do guesswork here. This explainer is going to completely rewire how you look at momentum. We're going to force you to drop the gut instincts and start relying on hard, undeniable quantitative data.
So here's our curriculum for today. First up, the illusion of direction. Number 2, the directional movement matrix. 3 is measuring raw horsepower. 4, the architectural trend filter. And finally, number 5, we wrap up with the strength audit. Like I said, no more guessing. We are mathematically tracking institutional momentum today. Let's get right to work. All right, section 1, the illusion of direction. So yesterday on day 124, we tackled the statistical probability channels of market volatility with Bollinger Bands. But, volatility is only half of the structural equation. What's the missing link? Engine power. I want you to really absorb this quote on the screen. The single biggest flaw in beginner trading is focusing 100% of psychological energy on direction, because direction is useless without strength. Man, that just perfectly nails the amateur mindset, doesn't it? Beginners, they completely obsess over one fatal question. Is this thing going up or is it going down? They literally pour all their mental capital into predicting direction. But listen, as an architect, you've got to realize something crucial. Direction is completely 100% meaningless if there isn't enough underlying force to actually sustain the move. Think about it. You see a minor trendline breakout and boom, you just assume a massive run is coming. But because it has low internal horsepower, it collapses into a false signal almost immediately.
Yeah, and that is exactly where retail traders get chopped up into, well, liquidity confetti. So the question is, how do we solve this? How do we actually quantify the literal engine power of the market without just guessing?
Well, we use the Average Directional Index, or the ADX, which was developed by the legendary J. Wells Wilder. Which brings us to section 2, the directional movement matrix. Now, to really upscale your analytical neurofitness today, you've got to completely banish the idea that the ADX is just a single, simple little line on your chart. It is not. It's actually a highly dynamic mathematical matrix that tracks a default 14-period window. So let's rigorously define these internal components, all right? On one side, we have the plus directional indicator, the plus DI. This measures structural upward strength. It quantifies exactly how aggressively buyers are pushing those daily highs upward.
And right across from that, contrasting it, is the minus directional indicator, the minus DI. This one measures the structural downward strength, showing us just how aggressively the sellers are driving daily lows downward. So it's essentially a literal mathematical quantification of buyers' aggression versus sellers' aggression playing out on the grid.
And this dynamic directly brings us to operational control. You see, when that plus DI line crosses cleanly above the minus DI line, it's signaling a very exact mathematical event. What it means is the buyers have captured temporary operational control of the order book grid. They've officially seized the initiative. Moving right along to section 3, measuring raw horsepower. So we know who is fighting for control, right? But how do we actually gauge the total output of the engine that's driving them? Well, that output gauge is the ADX line itself. Technically speaking, it's a smoothed moving average derived from the absolute mathematical difference between the plus DI and the minus DI.
Right, and I need you to internalize an absolutely critical, non-negotiable rule about this gauge. The ADX line is completely and utterly direction agnostic. It does not care if the asset is crashing to absolute zero or if it's blasting to the moon. It only calculates the raw intensity of the trend, period.
Exactly. And it measures that raw intensity on a definitive mathematical scale from 0 to 100. This is it. This is your ultimate measurement of trend speed.
Co-host, think of it kind of like the tachometer in a sports car. It doesn't tell you if you're driving north or driving south. It just tells you that the engine is redlining. By placing trend power on this 0 to 100 numerical scale, we establish ironclad quantitative thresholds. And those thresholds, they dictate our capital allocation.
Let's systematically break down these mathematical laws of the order book. First off, if the ADX is below 20, you are in what we call the flat chop zone. The trend engine is dead, buyers and sellers are basically in a stale checkmate, resulting in this nasty sideways capital grind. A smart architect halts aggressive trading here to preserve capital.
Absolutely, you just stay out. But when the ADX crosses above 25, boom, that is your structural expansion trigger. The validation signal has flashed, a high horsepower trend is officially ignited, and institutional momentum is locked in.
Finally, when ADX hits up between 40 and 50, you've reached the overextended peak. The trend has expanded to its absolute extreme limits and is burning through available market liquidity clips fast. At this point, a sharp mean reversion or a consolidation freeze is imminent. This is the exhaustion danger state, so watch out. Okay, let's look at how we apply this. Section 4, the architectural trend filter. We have an absolute mathematical rule here, folks. Never, and I mean never, buy a breakout if the daily ADX line is rotting down at 14.
Let's use a really concrete example to tie this together with day 123's lesson. Say an asset attempts to break out above a major horizontal volume profile POC node. Looks great, right? But if the daily ADX line is sitting dead at 14, you know mathematically that the move is a retail illusion. It completely lacks institutional sponsorship. It's a trap, and it will fail.
Conversely, let's contrast that trap with a mathematically validated signal. First, a structural breakout occurs. Simultaneously, the ADX line breaks vertically above 25, and finally, the plus DI tracks aggressively over the negative DI. And the result of that setup? The structural bull train has officially left the station. When you align your capital allocation vectors with these three exact conditions, you are no longer just guessing. You are structurally riding the macro wave. Which leads us nicely into Section 5, the strength audit. This masterclass requires action, guys. We don't just sit back and observe the data, we deploy it. So you need to execute an immediate operational audit right after this session. Step 1, open your charting software, like TradingView, and set it specifically to the daily time frame.
Step 2, add the standard directional movement index, the DMI. That's the one that bundles the plus DI, the minus DI, and the ADX together into one complete matrix. Next, I want you to review the major multi-week trend moves over the past year. Track the exact coordinate where the ADX line breached that 25 threshold wall.
And finally, check the horsepower thermometer right now on your active portfolio slots. You've got to stop trading weak, directionless noise and start aggressively filtering by trend intensity. I'm going to leave you with this final, provocative question to really challenge your current market positioning. Look at your holdings and ask yourself, is your active portfolio currently riding a mathematically validated macro wave, or is your capital slowly grinding to zero in the dead zone? Audit the horsepower, filter by trend intensity, and rule the cycle. Thanks for joining us for day 125 of this explainer. Until tomorrow, stay focused and stay highly analytical.